You get a bonus, a tax refund, or sell some old gear, and suddenly you're sitting on $1,000 in cash. Immediately, you face the pressure of deciding which of the three distinct paths to take to make the perfect financial move. Open any app and someone is shouting at you to dump it into a crypto altcoin, quietly park it in an S&P 500 index fund, or drop ship your way to financial freedom. This vertical bar chart shows your baseline principal, exactly $1,000. To figure out what to actually do with it, we have to separate percentage returns from absolute returns, meaning the actual number of physical dollars you get to put in your pocket. If you invest that $1,000 in the broader stock market and get a standard historical return of 7%, you earn $70 for the year. But if you carry a $1,000 balance on an average credit card at 24% interest, you owe $240 in penalties over that same year. $70 over 12 months is roughly $5.80 a month. That is objectively not enough money to quit your job, upgrade your apartment, or build wealth. Because the actual absolute dollar output is so low, you can't treat $1,000 like traditional investment capital. Instead, you have to treat it as leverage capital, a specialized tool you use to force a specific change in your financial baseline. Deploying leverage capital requires choosing between two distinct paths: passive certainty on one side and active asymmetry on the other. Passive certainty requires almost zero ongoing effort once the money is parked. The trade-off is that your absolute returns will be mathematically predictable and modest. Active asymmetry swings in the exact opposite direction. You gain the potential for exponentially higher financial returns, but you completely forfeit any guarantee of success. You also have to supply the engine for that growth. An active asymmetric play demands hours of your own physical or mental labor to perform. You don't pick between these paths by guessing what the stock market is going to do next week. You choose by auditing your own balance sheet, looking at your current liabilities, and figuring out what you actually need the money to accomplish. That brings us to the first of three strategic paths, the debt killer. This matrix shows how each of the three options measures up. The debt killer strategy requires a strict input. You take the $1,000 and throw it directly at your high-interest credit cards. Mathematically, preventing a bank from charging 20% annual interest operates exactly like earning a 20% guaranteed tax-free yield. No traditional market investment accessible to everyday retail investors guarantees a 20% return year over year. The drawback is you aren't buying an asset. Zero liquid cash flow is generated, and your net wealth doesn't grow. It just stops shrinking. Psychologically, this is a grueling move. You are spending your new cash to pay off things you've already consumed, which delivers absolutely no dopamine hit and zero visible financial progress in your bank account. This path is strictly financial triage. You have to stop the bleeding and secure your baseline survival before you can even begin the process of building wealth. If the bleeding is already stopped, you can look at the second path, the passive foundation. Here, you deposit your capital into a broad market index fund or an ETF. An ETF, or exchange-traded fund, is a basket of different stocks you buy all at once to easily diversify your money. The strict rule here is time. The $1,000 must be locked away and left untouched for a decade. By leaving it alone, your reward is establishing the habit of investing and watching a balance fluctuate without panicking. Your secondary reward is defensive. Market growth protects your capital's purchasing power from long-term inflation. But the trade-off is severe illiquidity. If your car breaks down and you need that cash, you might be forced to sell during a downturn and take a permanent loss. Furthermore, the absolute monetary gains during those first 5 years will be agonizingly small. This strategy is merely a psychological starting line for a process that takes a lifetime to play out, not a mechanism for rapid financial transformation. The third and final option requires an entirely different mindset, the human capital play. You spend your $1,000 on certifications or equipment to launch a side hustle. The goal is acquiring a skill that permanently increases your earning power or builds an independent income stream. The drawback? Zero guarantee of success and high failure risk. If you buy a welding machine or a coding bootcamp subscription and then never practice, the monetary value of that investment drops to exactly zero. It pays no passive dividends. The true cost of this path isn't the $1,000. The true cost is the sacrifice of hundreds of hours of your own personal leisure time to actually learn and apply the new skill. You are trading extreme personal risk and intense labor for the chance to capture the highest possible absolute return on a small principal. Because these three paths are so different, one-size-fits-all financial advice is dangerous. You have to diagnose your own baseline using a scenario match framework. This flowchart maps out the decision. The very first question you have to ask yourself is, do you have high-interest consumer debt? If the answer is yes, you fall into the debt-burdened beginner segment. Your $1,000 goes straight down the debt killer path. You must completely ignore the stock market. Eliminating that 20+% interest rate penalty is the only mathematical way to ensure your financial survival. If you are debt-free, you move to the second diagnostic question. Do you currently have the spare time and mental energy to build a completely new skill? If you answer yes to that, you are an active optimizer. Your capital routes directly to the human capital play. Because you have the baseline security of zero high-interest debt, you can afford to accept the high failure risk of new operational ventures to maximize your absolute returns. If you answer no, meaning you are debt-free but lack the extra time or energy for a second job, you are an aspirational passive investor. You take the path to the passive foundation. Your job here is to mentally accept the reality of slow, steady compounding without expectations of quick wealth. The objectively best investment doesn't exist in a vacuum. It only exists within the exact context of your personal balance sheet.